Before we begin, please remember that this presentation is for informational purposes only and should not be considered financial, legal, or investment advice. I am not a licensed financial advisor. The world of mortgages is complex and regulated, and your individual situation is unique. Always consult with a qualified mortgage professional and a financial advisor before making any decisions regarding your home loan. You found it. The perfect house. Not just a house, a home. You can already see the couch in the living room. Smell the barbecue in the backyard. Picture your life unfolding inside those walls. You've saved, you've sacrificed, you've built your credit score with the focus of a hawk. You submit the mortgage application, your heart pounding with a mix of excitement and anxiety. And then a week later the email arrives. The one with the subject line that makes your stomach drop. An update on your mortgage application. You open it, and there are the words, cold and digital. We regret to inform you. Denied. The reasons blur together. Insufficient income history. Debt-to-income ratio is too high. Credit file is too thin. Feels like a punch to the gut. The American dream, the one you worked so hard for, just slammed the door in your face. It's a devastatingly common story. But what if I told you there's a secret key? A financial backdoor that the vast majority of aspiring homeowners have no idea even exists. A strategy that can take a no from a lender and turn it into a yes, sometimes in a matter of days. This isn't about saving a bigger down payment or finding a magical credit repair trick. This is about leveraging the strength of someone you trust, without them having to give you a single dollar. Today we are pulling back the curtain on one of the most powerful, yet misunderstood, tools in American real estate, the mortgage guarantor. And by the end of this video, you will know exactly what a guarantor is, why they are fundamentally different and often much better than a cosigner who can qualify to be one, and how you can use this strategy to finally get the keys to your dream home. This is the information that can change your life. So let's start with the absolute basics. What on earth is a mortgage guarantor? Think of a guarantor as your financial safety net. They are a person, usually a close family member like a parent, who promises the bank, "Hey, I trust this borrower. If and only if they completely fail to pay their mortgage, and the bank forecloses, and the sale of the house still doesn't cover the loan, then I will step in and cover the difference." They are the bank's insurance policy. They don't make your monthly payments. They don't help with the down payment. Their name is not on the title or the deed to the house. They have zero ownership rights. They are, in essence, a silent partner whose only job is to exist in the background, providing the lender with the confidence to approve your loan. Why would a bank agree to this? Because getting a mortgage is all about risk. Lenders look at you and they ask one question. How likely is it that we're going to get our money back? When they see a short work history, a pile of student loan debt, or a credit score that's just shy of their target, they see risk. But when you bring a guarantor to the table, someone with a long, stable income, a fantastic credit score and significant assets, you are fundamentally changing the bank's risk calculation. The guarantor's financial strength acts as a powerful counterbalance to whatever weaknesses the lender sees in your application. You're no longer just you. You're you, plus the financial credibility of your guarantor. It's a game changer. So who is this for? Who are the people who can benefit most from this strategy? Let's see if you recognize yourself in any of these scenarios. First, there's the recent graduate. You landed a great job with a solid salary, but you've only been there for a year, maybe less. You have a mountain of student debt, and your credit history is short because you've only had a credit card for a few years. To a lender, you look like a gamble. A guarantor with a long, stable career can bridge that gap and show the lender that your new income is secure. Next, we have the entrepreneur or freelancer. You might be making great money, maybe even more than someone in a traditional 9-to-5. But your income is variable. It comes in large, unpredictable chunks. Lenders hate unpredictability. They want to see 2 years of steady, consistent W-2 paychecks. A guarantor can provide the stability your fluctuating income lacks, assuring the bank that the mortgage will be paid, even during a slow month. Then there's the credit rebuilder. Maybe you went through a tough time a few years ago. A divorce, a medical emergency, a job loss, and your credit took a hit. You've been doing everything right since then, paying every bill on time, but your score is still recovering. It might be a 640 when the lender wants to see a 680. A guarantor with an 800-plus credit score can completely overshadow your past mistakes in the eyes of the bank. Finally, there's the person with a high debt-to-income ratio, or DTI. This is one of the biggest dream killers in the mortgage world. You might have a great income and a great credit score, But you also have a car payment, the last of your student loans, and some credit card debt. When the lender adds your potential mortgage payment to the pile, your total monthly debt payments are more than, say, 43% of your gross monthly income, and their computer says, no. A guarantor doesn't lower your debt, but their presence can convince an underwriter to be more flexible on those DTI limits, giving you the wiggle room you need to get approved. If you fit any of those profiles, a guarantor could be the solution you've been looking for. But right now you might be thinking, wait a minute, this just sounds like a cosigner. My parents said they'd never cosign for anything. This is the single most important point of this entire video, and a distinction that could make or break your conversation with a potential guarantor. A guarantor is not a cosigner. Confusing the two is like confusing a firefighter with an insurance agent. They are both involved with fires, but their roles are profoundly different. Let's break it down. A cosigner, also known as a co-borrower, is on the front lines with you from day one. Their name goes on the mortgage application right next to yours. They are equally and immediately responsible for every single monthly payment. If a payment is 30 days late, it hits the cosigner's credit report just as hard as it hits yours. Their name is also on the title of the house, meaning they are a legal co-owner. This has huge implications. Because they are an owner and a borrower, that mortgage debt appears on their credit report as their own, which can severely impact their ability to get a loan for themselves in the future, like for a car or an investment property. A guarantor, on the other hand, is in the reserves. They are what's known as a contingent liability. Their responsibility only kicks in under a worst-case scenario. You, the primary borrower, are the only one responsible for making the monthly payments. If you're late, it affects your credit, not theirs. The guarantor isn't even notified unless you go into serious default. And they only have to pay the bank if you default. The bank forecloses on the home, sells it at auction, and there is still a remaining balance on the loan. It is a last resort, not a first resort. Their name is not on the title, so they have no ownership. The debt does not appear on their day-to-day credit report, leaving their own borrowing power intact. Think of it this way. A cosigner is your co-pilot, sitting next to you in the cockpit, responsible for every move the plane makes. A guarantor is the emergency parachute packed in the back. You hope you never have to use it, but the pilot, the bank, feels a lot safer knowing it's there. Understanding this difference is absolutely critical, because when you ask someone to be your parachute, it's a very different conversation than asking them to co-pilot the plane with you for the next 30 years. So let's talk about that conversation, because walking up to someone, a parent, a grandparent, a mentor, and asking them to be your guarantor is one of the most significant financial conversations you will ever have. It's not just about money. It's about trust, responsibility, and their future, not just yours. Get this wrong and you could damage a relationship forever. Get it right and you could unlock the door to your first home years before you thought possible. To understand how to get it right, we first need to understand why the bank wants a guarantor in the first place. Imagine you're the loan officer at the bank. Someone walks in, sits down at your desk, and asks for several $100,000. What's going through your mind? You're not just looking at numbers on a page. You're trying to answer one fundamental question. Can I trust this person to pay us back every single month for the next 30 years? To answer that question, lenders have a sort of unwritten rulebook, a checklist they use to measure your trustworthiness. It generally boils down to three things, sometimes called the 3 C's of credit: capacity, capital, and character. Capacity is simple. Do you have the capacity to pay the loan back? They look at your income, your job stability, and most importantly, your debt-to-income ratio, or DTI. This is a huge one. They take all your monthly debt payments, student loans, car payments, credit card minimums, and divide it by your gross monthly income. If that number is too high, let's say over 43 to 45%, alarm bells start ringing. It signals that you might be stretched too thin, that one unexpected car repair could throw your entire budget into chaos and cause you to miss a mortgage payment. Next is capital. This is about what you have in the bank, your savings, your investments, your down payment. Lenders see this as your skin in the game. A person putting down 20% of their own money is seen as a much lower risk than someone scraping by with the bare minimum. Capital also refers to your reserves, the cash you'll have left over after closing. They want to see that you have a cushion, a few months of mortgage payments sitting in an account just in case you lose your job. It's a safety net. And the third, and arguably most important C, is character. This isn't about whether you're a good person. It's about your financial character, your track record. And how do they judge that? Your credit report and your FICO score. Have you paid your bills on time in the past? How long is your credit history? Do you have a good mix of different types of credit? A high credit score, say 740 or above, tells the lender that you have a long documented history of being a responsible borrower. You are a known quantity. Now, let's think about the typical person who might need a guarantor. Maybe it's a recent medical school graduate. She has a fantastic, high-paying job lined up, so her capacity looks great on paper. But she also has a mountain of student loan debt, which makes her DTI ratio borderline. She has some savings for a down payment, but not a ton of capital in reserve. And most critically, her character. Her credit history is short. She's only had a credit card for a few years. She's never had a major installment loan before. From the lender's perspective, she's a question mark. The income is great, but the high debt is a risk. The short credit history is a risk. The low reserves are a risk. The lender is on the fence. They want to give her the loan, that's how they make money, but their rulebook is flashing yellow lights all over the place. This is the precise moment the guarantor steps onto the stage. The guarantor is the lender's answer to all those yellow lights. Your guarantor doesn't necessarily add their income to yours to help you with the DTI ratio. That's more of a co-borrower move. Instead, the guarantor acts as a powerful backstop. They are your financial parachute. The lender looks at the guarantor's profile. And what do they see? They see someone who is the polar opposite of the applicant. Someone with a long, pristine credit history, a FICO score of 800 plus. Someone with a very low debt-to-income ratio, maybe their own house is paid off. Someone with significant capital, retirement accounts, investments, a healthy savings account. Suddenly, the lender's entire calculation changes. The applicant's short credit history? It's still short, but it's now backed by someone with decades of perfect payment history. The applicant's tight DTI ratio? It's still tight, but if she stumbles, there's a financially solid individual legally obligated to make the payment. The applicant's low cash reserves? They're still low, but the guarantor has deep reserves that could cover the mortgage for years if necessary. The guarantor's strength covers the applicant's weaknesses. They absorb the risk. They turn the lender's maybe into a confident yes. So, who can be this financial superhero? It can't be just anyone. A lender is going to scrutinize your potential guarantor even more intensely than they scrutinize you. Typically, this person needs to be a close relative, a parent, grandparent, or sometimes a sibling or aunt and uncle. Lenders prefer a family relationship because it implies a level of personal commitment beyond a simple contract. And their financial house needs to be in impeccable order. We're talking a credit score that is excellent, usually 720 at the absolute minimum, but realistically they want to see 760 and up. Their own debt-to-income ratio needs to be very low, providing plenty of room for them to theoretically take on your mortgage payment without stress. And they need to show significant, verifiable income and assets. The lender needs to be convinced, beyond a shadow of a doubt, that if you default on day one, the guarantor can and will step in and carry that loan to term without breaking a sweat. This is why the conversation is so critical. You're not just asking for a signature. You are asking them to undergo a full financial colonoscopy by a mortgage lender. You are asking them to put their own perfect financial record on the line for you. You are asking them to legally bind their financial future to yours for potentially decades. So when you approach them, you can't be casual. You need to treat it like a business proposal because it is. You need to have your own ducks in a row first. You should have your budget worked out to the penny. Show them exactly how you will afford the monthly payment, the insurance, the taxes, the upkeep. You need to have a contingency plan. What happens if you lose your job? Show them you have an emergency fund, even if it's small, and a plan for how you would find new work. You need to be transparent about the risks to them. Explain that this will show up on their credit report as a contingent liability. Explain that if you are late, it damages their credit score. And explain the worst-case scenario. If you default, the bank will come after them for the money, and could even go after their assets. You owe them the unvarnished truth. By laying it all out, you're not scaring them off. You're showing them that you are mature, responsible, and that you fully grasp the gravity of what you're asking. You're demonstrating that you are a good risk. But here's the thing. Even if you find the perfect person and have the perfect conversation, and they enthusiastically agree, you could still be stopped dead in your tracks. Because not all loans are created equal. The most common, most popular types of mortgages in the United States have very, very specific, and often restrictive rules about using a guarantor. And if you don't know these rules, you could waste months of your time and effort, only to be rejected at the final hurdle for a reason you never saw coming. So let's pull back the curtain on the single biggest, most common, and most heartbreaking mistake people make. It's a mistake rooted in a simple assumption. The assumption is that if someone is financially strong, loves you, and is willing to help, they can be your guarantor. That your rich uncle, your successful mentor, or your lifelong best friend can just sign on the dotted line and get you into your dream home. But in the world of mortgages, especially certain types of mortgages, that assumption can lead you straight into a brick wall. The problem is, the U.S. mortgage system isn't one single entity. It's a patchwork of different loan types, each with its own rulebook. And the first rulebook we need to open is the one for FHA loans. FHA loans are incredibly popular, especially for first-time homebuyers, because they allow for lower down payments and are more forgiving on credit scores. They are the go-to option for millions. And it's here, in the fine print of the FHA guidelines, where so many dreams of using a guarantor come to a screeching halt. Here is the bombshell rule. For an FHA loan, your guarantor, or as they officially call them, a non-occupant co-borrower, almost always has to be a family member. Let that sink in. It doesn't matter if your mentor is a billionaire. It doesn't matter if your best friend has a perfect 850 credit score and zero debt. If they are not a family member, the FHA in most cases will say no. They have a specific, approved list of who qualifies. We're talking about parents, grandparents, children, siblings, aunts, uncles, even in-laws and step-relatives. But a cousin? Usually not. A fiancé? No. A best friend you consider a brother? Not a chance. Imagine you've spent 2 months searching for a home. You found the one. Your mentor, a person who has guided your career and wants to see you succeed, has generously agreed to co-sign. You've submitted all your paperwork. The lender has pre-approved you based on the combined income. You're already picking out paint colors. Then you get the call. The underwriter, the person who gives the final stamp of approval, has looked at the file and flagged it. Your co-signer isn't a family member. The entire loan is denied. All that time, all that emotional energy, all that hope gone, because of one rule you never knew existed. Now why? Why is the FHA so strict about this? It all comes down to their assessment of risk. The Federal Housing Administration, which insures these loans, believes that a family member has a deeper, more compelling interest in preventing a foreclosure. They believe a mother or a father is more likely to step in and make payments if their child is struggling, not just to protect their own credit, but to protect their family. They're betting on the power of the family bond over a business or friendly relationship. They see a friend or mentor as a higher flight risk if things go south. It's a cold, calculated business decision disguised as a family-first policy. So, if you were planning on using a non-relative for an FHA loan, you basically have to stop and completely rethink your strategy. But here's the good news. This is where the path splits. The FHA is not the only game in town. If the FHA door slams shut, another one opens. And that door leads to the world of conventional loans. Conventional loans are the other major category of mortgages. These are the loans that aren't insured by the FHA or the VA. Instead, they follow the guidelines set by two giant government-sponsored enterprises you've probably heard of, Fannie Mae and Freddie Mac. And here is the crucial difference. Conventional loans are far more flexible about who can be your guarantor. With a conventional loan, your guarantor does not typically need to be a family member. Your successful mentor? Back in the picture. Your financially stable best friend? Absolutely. Your business partner? It's possible. This flexibility is a game changer for a huge number of people. It opens up a world of possibilities that the FHA framework locks down. But, and you knew there was a but coming, this flexibility comes with a different set of challenges. While they are more relaxed about who can co-sign, they are often much stricter about that person's financial qualifications. The FHA might be okay with a family member who has a decent credit score and a reasonable amount of debt. A conventional loan underwriter, on the other hand, is going to put your non-family guarantor under a high-powered financial microscope. They will be looking for an exceptionally strong borrower. We're talking about a high credit score, often well into the mid-700s or higher. They'll be looking for a very low debt-to-income ratio, or DTI. And this is where we need to get into the nitty-gritty of how a lender really thinks. Your DTI is the single most important number in qualifying for a mortgage. It's a simple percentage. You take all of your monthly debt payments, your rent or current mortgage, car payments, student loans, minimum credit card payments, and you divide it by your gross monthly income. So if you have $2,000 in debt payments each month and you make $6,000 a month, your DTI is 33%. When you bring in a guarantor, the lender doesn't just look at their income. They look at their entire DTI picture, and they add it to yours in a specific way. Let's go back to our story. You and your mentor, after being rejected for the FHA loan, now apply for a conventional loan. Your mentor makes $200,000 a year, which sounds amazing. But your mentor also has their own $500,000 mortgage, 2 luxury car leases, and hefty credit card bills from their business. The lender adds up all of your monthly debts and all of your mentor's monthly debts. Then they add up all of your monthly income and all of your mentor's monthly income. They create a new blended DTI for this borrowing team. And this is the trap. Your guarantor's huge income might be completely canceled out by their equally huge debt load. It's like trying to fill a bucket with a hole in it. The water pouring in is the income, but the water pouring out is the debt. If the hole is too big, the bucket never gets full enough to satisfy the lender. Many conventional loans want that final blended DTI to be under 43% or even lower. So even with a wealthy guarantor, if their own lifestyle creates a lot of monthly debt obligations, their participation might not actually help you qualify. It could even hurt your chances if their DTI is worse than yours. The lender's logic is simple. They are asking themselves, if the primary borrower, that's you, loses their job, can this guarantor realistically afford to pay their own bills and this new, entire mortgage payment without breaking a sweat? They need the answer to be a resounding yes. They want to see a guarantor with so much financial breathing room, so much surplus income every month, that taking on your mortgage payment would be an inconvenience, not a catastrophe. So the trade-off is clear. FHA loans demand a family relationship, but can be more forgiving on the numbers. Conventional loans offer relationship flexibility but demand rock-solid, almost pristine financial strength from the guarantor. Knowing which path to take, which set of rules to play by, is the first and most critical strategic decision you have to make. It will determine who you can even ask for help and what kind of financial scrutiny they will have to endure. But understanding these rules is only half the battle. Because once someone agrees and once they meet the lender's strict criteria, they are stepping into a binding legal and financial commitment that is far more serious than most people realize. The risks for the guarantor are immense, and many of them are hidden in the fine print of the closing documents. What are they actually on the hook for? What happens if you're a day late on a payment? And what is the one thing a guarantor must do to protect their own financial future? A step that almost no one takes. We'll break down that shocking reality next. Let's pull back the curtain on the guarantee. When someone, let's call them your parents, agrees to be your guarantor, they are not just signing a piece of paper that says, "I vouch for my kid." They are signing a legally binding contract that says, "I am this loan, just as much as my kid is." This is the single most misunderstood aspect of the entire process. The lender, the bank, now sees two people as one single entity. They are not a backup plan. They are the primary plan. They are on the hook for every single penny of the principal, the interest, the property taxes, and the homeowner's insurance from day one. It's not a sequential responsibility where the bank has to chase you down first, fail, and only then can they call your guarantor. No, they have the legal right to demand payment for the full amount from your guarantor the very second the loan is considered in default, often skipping you entirely if they perceive the guarantor as the easier path to payment. Think of it like this: you and your guarantor are co-pilots in a plane. But it's a special plane with dual controls that are permanently linked. Every move you make on your controls, every dip, every climb is felt identically on their side. If you decide to take a nap and let go of the yoke, the plane doesn't just wait for you. The other pilot, your guarantor, is now wrestling with the full force of the aircraft, trying to keep it from nosediving. And the air traffic controller, the bank, doesn't care which pilot is flying. They just want the plane to stay on its flight path and land safely. If it doesn't, they hold both pilots equally and completely responsible for the crash. So what happens if you're a day late on a payment? Or 5 days late? In most cases, not much beyond a potential late fee for you. The real damage, the thing that sends a shockwave through the guarantor's financial life, happens after 30 days. The moment your payment is 30 days past due, the lender reports that delinquency to the 3 major credit bureaus: Experian, Equifax, and TransUnion. And here's the brutal truth. They don't just report it on your credit file. They report the exact same delinquency on your guarantor's credit file. Let's make this real. Imagine your guarantor is your dad. He's 62, has worked his entire life, and has meticulously built a pristine 810 credit score. He's planning to refinance his own home next year to lower his payments heading into retirement. You, the borrower, have a tough month. Your car breaks down, a medical bill comes in, and you make a calculated decision to pay those things first and catch up on the mortgage in a couple of weeks. But life gets in the way and a couple of weeks turns into 35 days. You haven't told your dad because you're embarrassed and you're sure you'll fix it. One Tuesday morning, your dad gets an email alert from his credit monitoring service. He opens it and his heart sinks. His perfect 810 credit score has just plummeted to 720, a 90-point drop, overnight. A 30-day late payment is one of the most damaging single events that can happen to a credit score, and it stays on that report for 7 years. His plans to refinance are now either completely destroyed or will cost him tens of thousands of dollars more in interest because he's no longer a top-tier borrower. All because of a payment he didn't even know was missed. He is being punished severely for a mistake he didn't make and had no power to prevent. This isn't a scare tactic. This is the standard operating procedure for every lender in the United States. The guarantor's credit is inextricably linked to the borrower's actions. Every late payment, every default, every foreclosure proceeding appears on both of their credit reports as if they were the same person. The bank doesn't see a story, they don't see a tough month. They see a broken promise, and they report that broken promise against everyone who made it. This brings us to the one thing, the single most important, non-negotiable step a guarantor must take to protect themselves. A step that is almost universally ignored out of a misplaced sense of trust or a fear of awkwardness. What is it? The guarantor must, as a condition of signing, demand to have their own personal, read-only access to the online mortgage loan portal. Let me say that again. They must have their own login to the bank's website to view the loan status. Why is this so critical? Because it's the only way to move from a reactive position to a proactive one. It's the difference between finding out about the fire when the smoke alarm is blaring and your house is engulfed in flames, versus smelling the smoke when it's just a small fire in a wastebasket that you can easily put out. Without this access, the guarantor is flying completely blind. They are relying 100% on the borrower to be perfect, or at the very least, to be a perfect communicator when they're not. And let's be honest, the moment someone is in financial trouble is the exact moment they are least likely to communicate openly, especially with the person they feel they are letting down. So the guarantor sits in the dark, assuming everything is fine, while their entire financial future hangs in the balance. The first notification they get of a problem is often that devastating credit alert, long after the damage is done. But with their own login, everything changes. The guarantor isn't being a helicopter parent or showing a lack of trust. They are being a responsible business partner, which is exactly what they are in this transaction. They don't need the ability to make payments or change account details. They just need the ability to log in on the 16th of every month, the day after the standard grace period ends, and see one of two things: a zero balance due or a payment that is outstanding. If they see the payment has been made, they can breathe easy and log out. It takes 30 seconds. But if they log in and see that the payment is 1 day past the grace period, they can now take action. They can pick up the phone. "Hey son, I was just checking my accounts and noticed the mortgage payment hasn't posted yet. Is everything okay?" This single action transforms the dynamic. It short-circuits the shame and embarrassment that prevents the borrower from coming forward. It turns a potential credit-destroying secret into a simple, solvable problem. The guarantor can then make an informed decision. They can find out what's going on. Maybe the borrower just forgot. Maybe they're in real trouble. The guarantor can then choose to make that month's payment themselves, directly to the lender, to protect their own credit rating. Yes, it creates an awkward situation and a new debt between them and the borrower, but it's infinitely better than the alternative. A 90-point credit drop, a ruined refinance opportunity, and a 7-year stain on their financial record. Getting this access is usually simple. The primary borrower can often add a user with limited, view-only permissions through the lender's portal. It should be a non-negotiable part of the deal. The conversation should be direct. "I love you and I am happy to do this for you, but my financial health is now tied to yours. For me to take on this enormous risk, I need transparency. I need a view-only login to the account. If you're not comfortable with that, then I can't be your guarantor." It's not about a lack of trust. It's about the presence of risk. You wouldn't co-pilot a plane and agree to have your instrument panel blacked out. This is no different. This one simple, often overlooked step is the guarantor's only real-time defense in a system where they have all of the liability and none of the control. But even with this crucial tool, what happens when it's not just one missed payment? What if the borrower loses their job and can't pay for 6 months or a year? What legal protections can be put in place before signing to create an exit ramp for the guarantor? And is it ever possible to get a guarantor's name removed from a mortgage without refinancing the entire loan? We're going to lay out the legal armor every guarantor needs to build around themselves next. Let's start with a brutal, uncomfortable truth. The standard guarantee agreement handed to you by a lender isn't designed to protect you. It's designed to protect them. It's a one-way contract written by their lawyers, for their benefit. Signing it as is like walking into a financial battle with no armor, no shield, and no weapon. You are willingly making yourself the easiest target on the field. So our first job isn't just to sign a document, it's to forge a suit of armor. We're going to build it piece by piece, starting with the most critical component, the breastplate. This is the guarantee agreement itself, but not the one they hand you. This is the one you negotiate. The single most important distinction you need to understand is the difference between an unlimited and a limited guarantee. An unlimited guarantee is exactly what it sounds like. It's a bottomless pit of liability. If the borrower defaults on a $300,000 loan, and the foreclosure sale only nets $200,000, you are on the hook for the $100,000 difference plus legal fees plus penalties plus interest. They can come after your savings, your investments, your retirement accounts, anything and everything until that debt is paid. It's financial suicide. A limited guarantee, on the other hand, puts a ceiling on your exposure. You can negotiate this limit. Maybe you agree to guarantee only the first 20% of the loan, which is often what the lender needs to feel secure. On a $500,000 loan, that's a $100,000 guarantee. It's still a massive number, but it's a known quantity. It's a risk you can measure and plan for. Or you could negotiate a burn-off provision. For every year the borrower pays on time, your guaranteed amount decreases. After 5 years of perfect payments, your obligation might be completely extinguished. This rewards good behavior and creates that exit ramp we talked about. Never, ever sign an unlimited guarantee. If the lender won't budge on this point, you need to walk away. It's that simple. Next, we forge the helmet. This is your independent legal counsel. Notice the word independent. This cannot be the borrower's real estate attorney. It can't be a family friend who dabbles in law. This must be your lawyer, paid by you, whose sole fiduciary duty is to protect your interests. Their job is to read every single line of that guarantee agreement, the one the lender's high-priced lawyers drafted, and find the traps. They will translate the dense legalese into plain English. They will tell you, this clause means they don't even have to try to collect from the borrower first. They can come directly to you. Or, this provision allows them to change the terms of the loan without your consent, but you're still on the hook. Hiring your own lawyer isn't an insult to the borrower. It's a non-negotiable business decision. Think of it this way: the bank has a team of lawyers. The borrower has a lawyer. If you don't have one, you are the only person at the table without professional protection. It's a recipe for disaster. This is the single best money you will spend in this entire process. With the breastplate and helmet in place, we need gauntlets. These are your asset protection strategies. A guarantee is a promise to pay, and if you have to pay, you want to control what assets are exposed. This is where you move from defense to offense. A sophisticated guarantor doesn't just leave their entire net worth hanging out in the open. They compartmentalize. This might mean working with your attorney and a financial advisor to move liquid assets into a more protected structure, like a family limited partnership or an irrevocable trust. It could mean ensuring your primary residence is titled in a way that offers maximum protection under your state's homestead exemption laws. For example, let's say you own a few rental properties under your personal name. If you sign a personal guarantee and the borrower defaults, those properties are fair game for the lender. However, if those properties were properly held within a series of LLCs before you ever sign the guarantee, it creates a formidable barrier. The lender can come after you personally, but attacking the assets inside the LLCs becomes exponentially harder. This is not about hiding money or evading responsibility. It is about intelligently and legally structuring your affairs so that one act of kindness doesn't have the power to detonate your entire financial life. This needs to be done well in advance. You can't just move everything into a trust the day before you sign the papers and expect it to hold up. This is proactive, strategic planning. Now for the shield. This is your exit strategy, and it answers that critical question: how do you get your name off the loan? The default answer is you can't, not without a full refinance. But we don't accept the default answer. Your lawyer needs to build a release clause. directly into the guarantee agreement. This clause is your shield. It will specify the exact conditions under which you are automatically released from your obligation. What are those conditions? The most common one is based on the loan-to-value ratio, or LTV. The clause might state that once the borrower has paid down the mortgage to the point where the loan balance is 80% or 75% of the home's appraised value, the guarantor is automatically released. This is a win-win. The bank has the equity cushion it wanted and you are off the hook. Another condition could be time-based. After, say, 60 consecutive on-time payments, the guarantee is terminated. The borrower has proven their reliability, and your job is done. Without this clause negotiated up front, you are at the mercy of the lender. They have zero incentive to ever let you off the hook. Why would they? You represent an extra layer of security for them. You have to build your own door out of the contract from the very beginning. Finally, every warrior needs a sword. Your sword is the right to notice and the right to cure. This is your ability to act before a situation spirals out of control. A standard agreement often doesn't require the lender to tell you anything. The borrower could miss one payment, then two, then three, and the first you hear about it is a formal demand letter for $80,000 after the default is official and your credit is already wrecked. Unacceptable. Your lawyer must insert a clause that requires the lender to notify you, the guarantor, in writing within a specific time frame, say 5 to 10 days, of any late payment. This is your early warning system. It allows you to pick up the phone and find out what's going on. Is it a simple oversight or a major problem? The second part of this is the right to cure. This gives you the legal right to step in and make the missed payment on the borrower's behalf to prevent a default. Yes, it means you're paying, but you're paying one mortgage payment, not the entire accelerated loan balance. It allows you to protect your own credit score and keep the loan in good standing while you sort out the problem with the borrower. You're not just a passive victim waiting for the axe to fall. You have the power to intervene. So let's review our armor. A limited, not unlimited, guarantee, independent legal counsel, proactive asset protection, a negotiated release clause, and the right to notice and cure. Without every single one of these pieces, you are exposed. With them, you transform from a potential victim into a well-protected and strategic partner. You've honored your commitment to help someone, but you've also honored your responsibility to protect yourself and your family. But here's the thing. All of this legal armor, all of this strategic planning, it's all designed to protect you if things go wrong with the borrower. What if we could spot the problems before we ever sign? What are the subtle and not so subtle red flags in a borrower's financial habits and character that should make a potential guarantor run for the hills? How do you have the incredibly difficult conversation about a co-borrower's spending habits, their job instability, or their lack of a financial cushion, without destroying your relationship? Because preventing the fire is always better than fighting it. So let's talk about how to have that conversation. Because it feels like walking on eggshells over a landmine. You're mixing family, friendship, and hundreds of thousands of dollars. It's the most emotionally charged financial decision you will ever make. The secret isn't to just be brave and blurt it out. The secret is to reframe the entire conversation. You are not confronting them. You are inviting them to co-create a business plan. Think about it. No sane person would start a business with a partner without a detailed partnership agreement. You discuss roles, responsibilities, capital contributions, and what happens if one person wants out. A mortgage is a 30-year business partnership. You need to treat it with the same seriousness. So you don't say, "Hey, I'm worried about your spending." You say, "Before we take this massive step, let's sit down and draft our own mortgage partnership agreement." It's what smart partners do to protect our investment and, more importantly, our relationship. By calling it an agreement or a plan, you immediately shift the dynamic. It's not you versus them. It's both of you versus the risk. It becomes a collaborative project, not an interrogation. And under the umbrella of this agreement, you can ask the hard questions without making them personal. First on the agenda, the financial deep dive. This is full, radical transparency. It's not just exchanging credit scores. It's printing out the last 3 months of bank statements and credit card statements and laying them on the kitchen table. Every subscription, every late-night Amazon purchase, every DoorDash order, everything. The goal isn't to judge. The goal is to establish a baseline reality of your combined cash flow. You can't build a 30-year plan on assumptions. You might discover one person has a $50 a day coffee and lunch habit they never even thought about, which is over $1,000 a month that could be going towards the mortgage or an emergency fund. You might find a secret credit card with a high balance. It's better to find that out over the kitchen table now than from a collections agency in 5 years. Second, you build the what-if scenarios. This is the core of your stress test. You game out the worst-case scenarios together. What if one of you loses your job? Who covers the full payment? For how long? Do you have enough in an emergency fund to cover 6 months of the full mortgage payment, taxes, and insurance? Not 6 months of one person's half, 6 months of the entire thing. If the answer is no, then your first step before even applying for the loan is to build that fund together. What if one of you gets a massive promotion and has to relocate across the country? Does the other person have to sell? Can they afford to buy the other person out? How will you determine the buyout price? Will you use the original purchase price or get a new appraisal? You need to decide this now when you're both calm and rational, not in the middle of a stressful life change. What if one of you becomes seriously ill or disabled? Is there disability insurance in place? Life insurance? Who becomes responsible for the debt? We assume our partner will always be there and be healthy, but a 30-year loan is a long time. Hope is not a strategy. Plan is a strategy. And the biggest one, what if the relationship ends? If you're not married, this is the financial equivalent of a nuclear bomb. You need a clear written plan for how the asset, the house, will be handled. Typically, there are 3 options. One person buys the other out, you sell the property and split the proceeds, or in a terrible market, you agree to become landlords together and rent it out until the market recovers. You have to agree on the mechanics of this before you sign the mortgage. It's a prenup for your property. Third, and this is non-negotiable for any guarantor or co-borrower, you must define the exit strategy. A mortgage is not a life sentence. For a guarantor, especially a parent, the goal should always be to get their name off the loan as soon as possible. Your agreement needs to spell out the exact conditions for this to happen. For example, after 60 consecutive on-time payments, and when the primary borrower's credit score is above 740, we will actively pursue a refinance to remove the guarantor from the loan. Be specific, measurable, achievable. It gives the borrower a clear target to aim for, and it gives the guarantor a light at the end of the tunnel. It's not an open-ended, indefinite risk. Now you might be thinking, this sounds great, but is this agreement legally binding? Honestly, probably not, unless you have a lawyer draft it, which is actually a fantastic idea. But that's not the primary point. The point of writing it all down and both signing it is to force clarity. When ideas are just floating in your head, they're vague. The act of writing them down forces you to confront the details. It creates a powerful moral and psychological contract. If things go south later, you can pull out that document and say, look, this is what we both agreed to when we were thinking clearly. It short-circuits the emotional arguments and the he said, she said nonsense. This process does one of 2 things. It either gives you and your partner incredible confidence to move forward, knowing you've stress-tested your plan and are truly aligned, or it reveals a fundamental incompatibility that would have destroyed your finances and your relationship down the road. It acts as a final critical filter. If your potential co-borrower is resistant to this process, if they get defensive about sharing their bank statements, if they don't want to talk about the what-ifs, that is not a red flag. That is a giant flashing, screaming red siren. It is the universe telling you to walk away. So that's the playbook for co-borrowers. But what about the classic guarantor situation, where a parent is co-signing for a child? The power dynamic is different, but the principles are identical. As the guarantor, you are the bank. It's your financial neck on the line. You have the right and the responsibility to set the terms. You can and should require your child to build that 6-month emergency fund before you sign. You can require them to have life and disability insurance. You can even make it a condition that for the first 2 years, they share their bank statements with you every month so you can verify that they're managing their cash flow responsibly. This isn't about being a helicopter parent. It's about being a responsible business partner. You can frame it perfectly. I am thrilled to help you build your future. My investment in you is not just financial, it's emotional. To protect both, we need a clear plan. This isn't about my trust in you. It's about our respect for the size of this commitment. The goal of all of this, the agreement, the stress test, the difficult questions, is to move the entire process from the fuzzy, emotional world of hope and trust into the clear, rational world of numbers and plans. Because when the worst happens, and in a 30-year timeline, something unexpected will happen, you don't want to be relying on fuzzy emotions. You want to be relying on the plan you made together when you were at your best. We've spent all this time building the perfect financial lifeboat, with a plan for every contingency. But what happens when you're in the middle of the ocean, and someone still manages to poke a hole in the boat? What happens legally and financially the very next day after a payment is missed? Now we move from prevention to crisis management, because the steps you take in the first 30 days of a default can mean the difference between a manageable problem and a decade-long financial nightmare. And the way the bank will come after you is something you need to be prepared for. Starts with a piece of mail. It looks official, heavy paper, with the bank's logo in the corner. You might mistake it for junk mail, but something tells you to open it. Inside, the language is cold, formal, and terrifying. It's a demand for payment or a notice of default. This letter isn't a suggestion. It's the first shot fired in a battle you never wanted to fight. It will state, in no uncertain terms, that the loan you guaranteed is delinquent. It will list the amount overdue, the late fees that have already piled on, and it will give you a deadline. Pay this amount by this date or else. The or else is where the nightmare begins. Let's rewind the clock 30 days. The primary borrower, maybe it's your son, your daughter, your best friend, missed a mortgage payment. On day 1, the bank's automated system simply flags the account. Between day 1 and day 15, the borrower probably gets a few gentle reminders. An email, a text message, an automated call. The tone is helpful, almost friendly. Did you forget? Click here to pay. For you, the guarantor, there is only silence. You have no idea anything is wrong. The bank has no obligation to notify you during this initial grace period. They are focused entirely on the primary borrower. But then day 16 hits. The grace period is over. A switch flips in the bank system. The account is now officially late. A significant late fee, often 4 or 5% of the monthly payment, is instantly added to the balance. The communication to the borrower becomes more frequent and much more firm. The friendly reminders are replaced with calls from a real person in the collections department. And it's around this time, usually between day 20 and day 30, that the legal machinery starts to turn towards you. The bank's risk management department looks at the file and sees your name, your signature, your promise. They see your stronger financial profile, the very reason you were approved as a guarantor in the first place. And they make a calculated decision. It's time to involve the backup plan. It's time to involve you. That's when the letter arrives at your door. And in that moment, when you're standing in your kitchen holding that piece of paper, your world tilts on its axis. The panic is real. Your mind races. How could this happen? Did they lose their job? Are they okay? But a more selfish, more primal fear quickly takes over. What does this mean for me? For my house? For my savings? For my credit score? At this exact moment, you stand at a critical fork in the road. Your next move will determine whether this is a temporary crisis or a permanent scar on your financial life. Path 1 is the path of immediate, decisive action. You swallow your anger, your fear, and your disappointment. You pick up the phone, but you don't call the borrower first. Not yet. Your first call is to the bank. You identify yourself as the guarantor, reference the loan number on the letter, and you ask one simple question. What is the total amount required to cure the default and bring the loan current? Get the exact number down to the cent. This is called the reinstatement amount. It's the missed payment, plus all the late fees and any other penalties they've tacked on. Then you pay it. You go online, you do a wire transfer, you drive to the bank and hand them a cashier's check. You get a receipt. You have just stopped the bleeding. By curing the default, you have reset the clock. The immediate threat of further collection activities, and more importantly, the initiation of foreclosure proceedings, is put on hold. You have bought yourself time. Path 2 is the path of denial and delay. You read the letter and you freeze. Or worse, you get angry. You think, this is their problem, not mine. They need to fix this. You call the borrower and it turns into a shouting match. They make promises they can't keep. I'll handle it, don't worry. So you wait. You ignore the letter. You hope it goes away. But it doesn't. The bank's collections department is a relentless machine. The letters will keep coming, each one more threatening than the last. They'll start calling you at home, on your cell, maybe even at work. After 30 days of delinquency, the bank reports the missed payment to all 3 credit bureaus, Equifax, Experian, and TransUnion. But they don't just report it on the borrower's file. They report it on yours. Your pristine credit score, the one you've spent decades building, takes a massive hit overnight. A 30-day late payment can drop your score by as much as 100 points. Suddenly, your own ability to get a loan, a credit card, or even a good insurance rate is in jeopardy, and the clock is still ticking towards foreclosure, the bank isn't being malicious, it's just being a bank. From their perspective, the loan agreement is a simple contract with two sources of repayment: the borrower and you. When source number one fails, they immediately pivot to source number two. In fact, they often prefer dealing with the guarantor. Why? Because you were approved specifically because you were the more financially stable party. You have the better credit, the higher income, the deeper assets. You are, in the cold calculus of banking, the lower-hanging fruit. They know that you have more to lose from a damaged credit report and the threat of legal action. They are counting on your fear and your financial stability to solve their problem for them. They will apply pressure methodically and legally until they get their money. Resisting or ignoring them is like trying to stop a tidal wave with a bucket. So let's assume you took path one. You were smart. You made the payment and cured the default. You should feel a moment of relief. You've dodged the immediate bullet. Your credit is safe for now, and the foreclosure train has been halted. But do not mistake this for a victory. You haven't solved the problem. You've only patched a hole in a sinking ship. The reinstatement payment doesn't address the reason the borrower missed the payment in the first place. Was it a one-time emergency like an unexpected medical bill or a car repair? Or is it the symptom of a much larger issue, like a job loss, a divorce, or a chronic inability to manage their finances? This is where the second and arguably harder part of your job begins. It's time for the most difficult conversation you will ever have with this person you chose to help. This isn't about blame or yelling, "I told you so." This is a financial triage. You need to sit down with them, look them in the eye, and become a forensic accountant. You need to ask the hard questions. What happened? I need the complete and honest truth. Show me your bank statements. Show me your budget. What is your income right now? What are all of your expenses? Was this a one-time slip? Or do you expect to have trouble with next month's payment too? You need to understand the reality of their financial situation, not the version they wish were true. Because if this was a temporary blip, you can create a plan for them to repay you for the payment you just made. But if they've lost their job or their income has been permanently reduced, you have a much bigger problem. Curing the default this month is pointless if they're just going to default again in 30 days. Each time that happens, you'll be on the hook for the payment, and the cycle of stress and financial drain will continue. If the problem is systemic, you can't just be a piggy bank. You have to become a crisis manager. You need to explore every single option. Can they get a roommate to reduce costs? Can they sell their car? Can they get a second job? You also need to look at options related to the mortgage itself. This is where you have to be their partner in contacting the bank again, not as an adversary, but as a team trying to find a solution. You'll need to ask the bank about loss mitigation options. Things like a forbearance, which temporarily pauses or reduces payments, giving the borrower time to get back on their feet. Or a loan modification, which permanently changes the terms of the loan, like extending the term or lowering the interest rate to make the monthly payment more affordable. But each of these options comes with its own set of consequences and complex paperwork. And it leads to an even more terrifying question. What happens if the borrower simply cannot afford the house anymore, no matter what you do? What if the only solution is to sell? And what if the house is worth less than what is owed on the mortgage? This is the reality you now face. You've moved beyond simply being a guarantor. You are now a co-pilot in a financial emergency, and the decisions you help make in the next few weeks could determine the course of both of your lives for the next decade. So the phone call ends. Your heart is hammering against your ribs. The voice on the other end, the one from the lender's loss mitigation department, was polite but firm. A missed payment has now become two, and the polite calls are about to be replaced by formal, legally binding letters. The first wave to hit you isn't anger or frustration. It's a cold, sinking feeling of dread. This abstract risk you signed up for years ago has just materialized in your kitchen on a Tuesday afternoon. It's real, and it's yours. Your first instinct might be to call the person you guaranteed the loan for and unleash a torrent of panic and blame. Don't. That is the single worst thing you can do right now. Your second instinct might be to ignore it, to hope it's a mistake that will sort itself out. That is even more dangerous. Right now, you are standing at a fork in the road. One path leads to containment and control. The other leads to financial ruin, destroyed credit, and a shattered relationship. The path you take is determined not by what you do next month, but by what you do in the next hour. Your first step is to take a deep breath and become an investigator. You need facts, not emotions. You are no longer just a parent, a friend, or a sibling. You are a stakeholder in a multi-$100,000 asset that is actively heading toward default. You need to put on your crisis manager hat. Your first call is to the borrower, the person you helped. This conversation will set the tone for everything that follows. You cannot lead with accusation. You must lead with a simple, calm question. I got a call from the lender. Tell me exactly what is going on. Then, you need to be quiet and actually listen. The reason for the missed payments is the single most important piece of information you can gather. It will dictate your strategy. Is this a temporary problem or a permanent one? This is the master key that unlocks the correct door. A temporary problem is a job loss where they have a promising new offer starting in 60 days. It's a sudden, unexpected medical bill that wiped out their savings but won't recur. It's a freelance client who paid late, causing a cash flow crisis that's now resolved. These are fires that can be put out. Permanent problem is different. It's a debilitating injury that prevents them from returning to their high-paying job. It's a divorce that has permanently cut the household income in half. It's a business failure with no prospect of recovery. These are not fires. These are structural collapses. And they require a completely different set of tools. Let's assume for a moment it's a temporary problem. The borrower lost their job but has a new one lined up. They're just in a gap. They're scared, embarrassed, and they've been avoiding the problem. Now that you're involved, the paralysis is broken. You, the guarantor, now have a clear mission. Build a bridge to the other side. Your very next call is to the lender, with the borrower on the line to give you authorization to speak on their behalf. Hiding from the lender is like trying to hide from the rain by standing in an open field. It's pointless and you're only going to get soaked. Lenders, despite their reputation, are not monsters. They are businesses. And a performing loan is always more profitable for them than a foreclosure. A foreclosure is a failure for them too. It's expensive, it's time-consuming, and they often lose money. So right now, in the early stages, you and the lender are actually aligned on one critical goal: avoiding foreclosure. When you speak to them, you are calm, professional, and prepared. You have the loan number, the property address, and the borrower's information. You explain the situation clearly and concisely. John Doe, the borrower, experienced a temporary job loss. He has accepted a new position and will have his first paycheck on this date. We want to understand our options to get the loan back in good standing. The lender's representative will likely shift from a collections mindset to a problem-solving one. They have a playbook for this. And your first and simplest option is called a reinstatement. This is the brute force method. You or the borrower simply pay the entire past due amount, including any late fees and penalties, in one lump sum. The loan is then considered current, and it's as if this never happened, except for the ding on the credit report. If you have the cash and the problem was truly temporary, this can be the cleanest way out. You write the check, the crisis is over. But it does nothing to address the underlying issue if the borrower is still financially fragile. It's a band-aid, not a cure. If a lump sum payment isn't feasible, you ask about the next tool in the box: a forbearance agreement. This is a critical term to understand. Forbearance is not forgiveness. It is a temporary, formal agreement with the lender to either pause your mortgage payments or reduce them for a specific period, typically a few months. This is designed for exactly the situation we described: a temporary hardship. During the forbearance period, the lender agrees not to initiate foreclosure proceedings. This gives the borrower breathing room. It allows them to get that new job, to stack a few paychecks, to get back on their feet without the crushing weight of an impending foreclosure. But here's the catch, and it's a big one. That money doesn't just disappear. At the end of the forbearance period, it has to be paid back. Usually, the lender will give you a few options. You might have to pay it all back in a lump sum, which can be difficult. Or, more commonly, they'll set up a repayment plan where your monthly payment is increased for a period of time until the missed amount is caught up. Or they might tack the missed payments onto the end of your loan term. As the guarantor, you need to understand which of these will happen because you are on the hook for all of it. A forbearance is an incredibly powerful tool, but it's a temporary pause, not a permanent solution. Now let's pivot. What if the conversation with the borrower reveals a permanent problem? The divorce is final. The second income is gone forever. The new job they can get only pays half of what the old one did. The current mortgage payment is no longer sustainable. A reinstatement or a forbearance is just delaying the inevitable. It's like putting a bucket under a hole in the roof. The bucket will eventually overflow. You don't need a bucket. You need to patch the roof. This is where you discuss a loan modification. A modification is a permanent change to the original terms of the mortgage. This is major surgery. The goal is to make the monthly payment more affordable for the long term. The lender might do this in a few ways. They could lower the interest rate to the current market rate. They could extend the term of the loan, for example, from 30 years to 40 years, which spreads the remaining balance over more time and thus lowers each payment. Or in some cases, they might even defer a portion of the principal balance, setting it aside to be paid off only when the home is sold or refinanced. Getting a loan modification approved is not easy. It's a long process that requires a mountain of paperwork. The borrower has to prove, in excruciating detail, their new financial reality. They'll need to submit hardship letters, pay stubs, bank statements, and a detailed budget. The lender will scrutinize everything. They need to be convinced not only that the borrower can't afford the old payment, but also that they can afford the new modified payment. And here is the critical part for you, the guarantor. If that loan is modified, you are still on it. Your name is still tied to that debt. In fact, you will likely have to sign the modification paperwork, reaffirming your guarantee on the new terms. You are now guaranteeing a 40-year loan instead of a 30-year one. You are recommitting to this person's financial life under a new set of rules. This is a decision with massive long-term implications. So you sit there at the financial triage station. You've diagnosed the problem, temporary or permanent. You've identified the potential treatments: reinstatement, forbearance, or modification. Each option presents a different path, a different cost, and a different risk to you personally. Paying to reinstate the loan costs you cash now. Agreeing to a forbearance means accepting a period of uncertainty. Pushing for a modification means chaining yourself to this obligation for potentially even longer than you originally planned. There is no easy answer. There is no option without a cost. You are a partner in this crisis now, and every decision is a shared one. But what if none of these work? What if the lender denies the modification? What if the borrower's situation is so dire that even a modified payment is too high? This is when the conversation shifts from saving the home to managing the exit, and the options become far more stark, far more damaging, and require you to make choices that can feel utterly brutal. The playbook of cooperation begins to close, and a new, more adversarial chapter threatens to begin. This is the moment the bank's patience officially evaporates. All the collaborative options, the short sales, the deeds in lieu, they were the bank's attempt to mitigate their losses with your cooperation. But when those fail, the bank shifts from a partner in problem-solving to an adversary in asset recovery. The first shot fired in this new war is a formal, legally binding document. It's often called a notice of default. When this piece of certified mail arrives, it changes everything. It's no longer a suggestion or a request. It is a declaration. It states in cold, hard legal language that the borrower has failed to meet their obligations, and that the lender is now exercising its contractual rights to reclaim its investment. And because you are the guarantor, a copy of that notice lands on your doorstep too. Your heart will stop when you see it. Your name, your address, printed right there on a document that screams financial failure. This notice often triggers something called an acceleration clause. This is a brutal but standard part of most mortgage contracts. It means the bank is no longer interested in missed monthly payments. They are now demanding the entire remaining balance of the loan. Immediately. If the mortgage has a balance of $300,000, they are now demanding $300,000. Not next year, not over the next 25 years. Now. And who are they demanding it from? Both the borrower and you, the guarantor. The phone calls you receive now are different. They aren't from the friendly loan modification department. They're from the bank's legal team or a third-party collections agency. The tone is no longer one of concern. It's one of demand. They will inform you in no uncertain terms that you are jointly and severally liable. This is a critical legal phrase that you need to understand. It means the bank can pursue the full amount of the debt from the borrower, from you, or from both of you simultaneously until the debt is paid in full. They don't have to get what they can from the borrower first. They can choose to come after the person with the deeper pockets and the better assets. They can come after you. At this point, the relationship between you and the borrower has likely shattered. The borrower, facing immense shame and financial pressure, may have gone silent. They might not be answering your calls, avoiding the topic, hoping it will all just go away. But for you, the guarantor, ignoring it is not an option. Your own financial life is now directly in the line of fire. The notice of default starts a clock. The time frame varies by state, but it's a countdown to the most feared word in real estate: foreclosure. Foreclosure is the legal process by which the bank seizes the property and sells it at a public auction to the highest bidder. In some states, this is a judicial process, meaning it has to go through the court system, which can be a slow, drawn-out affair. In other states, it's non-judicial, a much faster process handled outside of the courts based on the power of sale clause in the mortgage documents. As the guarantor, you are a helpless bystander to this process. You can't stop it. You don't own the home, so you can't sell it. You can't force the borrower to get their act together. You can only watch as the legal machinery grinds forward, chewing up the borrower's ownership and, with it, your credit score. Every single step of this process is reported to the credit bureaus. The notice of default, the foreclosure filing. These are catastrophic events for a credit report. Your score, which was likely pristine enough to qualify as a guarantor in the first place, will plummet. We're talking a potential drop of over 100, even 150 points. Suddenly, your own ability to get a car loan, a credit card, or refinance your own home is in serious jeopardy. You have been infected by a financial disease you did not cause. But the credit score damage, as devastating as it is not the end of the nightmare. It's just the beginning. The real danger for the guarantor lies in what happens after the foreclosure sale. Let's walk through a common and terrifying scenario. The outstanding mortgage balance is $300,000. The bank forecloses and the house goes to auction. In a forced sale environment, properties rarely sell for their full market value. Let's say the winning bid for the house is $220,000. After the bank pays legal fees, auction costs, and other expenses, let's say they net $200,000 from the sale. Simple math tells the story. They were owed $300,000. They collected $200,000. That leaves a shortfall of $100,000. This shortfall has a name, a deficiency, and in many states, the bank has the legal right to sue both the borrower and the guarantor for that amount. This is called a deficiency judgment. This is the moment the guarantee document you signed years ago, the one you probably didn't read closely enough, reveals its true teeth. It wasn't just a promise to pay if the borrower missed a few payments. It was a promise to make the bank whole no matter what. A deficiency judgment is a court order stating that you personally owe the bank $100,000. It is a legal debt, completely disconnected from the house, which is now gone. And a lender armed with a deficiency judgment is incredibly powerful. They can legally compel you to pay. They can garnish your wages, taking money directly from your paycheck before you even see it. They can levy your bank accounts, freezing them and seizing the funds inside. They can place liens on your other assets, including your own home, your car, or any investment properties you might have. This is the ultimate horror for a guarantor. Not only have you watched a loved one lose their home, not only has your credit been destroyed, but now the bank is actively coming after your own personal wealth. The savings you built for retirement, the equity in your own home you worked for decades to accumulate. It's all at risk. You could be forced to sell your own assets or drain your retirement accounts to pay for a house that someone else bought and lost. The borrower at this stage is often what's called judgment-proof. They may have no job, no assets, and no savings left. Suing them is like trying to get blood from a stone. But you, the guarantor, were chosen precisely because you were not judgment-proof. You were chosen because you had financial strength. And now the bank is turning that strength against you, using it as a resource to cover their losses. You are now facing a set of impossible choices. Do you declare bankruptcy yourself to discharge the debt, creating a 7 to 10-year black mark on your own financial life? Do you try to negotiate a settlement with the bank, offering them pennies on the dollar to make them go away? A process that requires expensive legal help and no guarantee of success? Or do you simply pay the massive judgment, potentially wiping out a significant portion of your net worth? This is the adversarial chapter. It's a world of lawyers, court filings, and ruthless collection tactics. The family bond that started this journey is a distant memory, replaced by a shared financial catastrophe. You are trapped. The bank holds a legal judgment, a court-sanctioned weapon, and it is aimed directly at your financial heart. The question is no longer if you will be harmed, but how badly. And as you receive a summons to appear in court, you realize the final, most devastating phase is about to begin. The legal papers feel cold, heavy, and final. It's not an accusation, it's a statement of fact. You are on the hook for the entire debt, and the lender, having exhausted its patience with the primary borrower, is now turning its full, undivided attention to you. Welcome to the world of collections litigation. In the eyes of the court and the lender, You are not a well-meaning parent or a helpful friend. You are co-debtor number 2. Your signature on that guarantee was a binding promise, and the time has come to make good on it. The first thing you'll likely discover is the terrifying concept of a deficiency judgment. This is the lender's ultimate weapon. See, when the borrower defaulted, the bank foreclosed and sold the house, usually at a public auction. But here's the brutal truth. Foreclosed homes rarely sell for the full amount owed on the mortgage. There are legal fees, maintenance costs, and the simple fact that auction prices are often depressed. Let's say the outstanding mortgage was $300,000, but the house only sold for $220,000. That $80,000 gap? That's the deficiency. And the bank has every legal right to come after both the borrower and you, the guarantor, for every last cent of it. The court summons is not a negotiation. It is the beginning of a process designed to extract that money from you by any legal means necessary. If you ignore it, the court will issue a default judgment against you, giving the lender even more power. If you show up, you'll likely be facing a corporate lawyer whose entire job is to win these cases. They have the documents. They have your signature. For them, it's a slam dunk. Once the judgment is secured, the lender can unleash a financial assault that can cripple you for years. First, they can garnish your wages. This means they get a court order sent directly to your employer, forcing them to withhold a percentage of every single paycheck, typically up to 25%, and send it directly to the lender before you even see it. Imagine working 40 hours a week but only getting paid for 30, week after week, month after month. Next, they can levy your bank accounts. This is even more direct. They get another court order, find out where you bank, and simply freeze your accounts. Then, they withdraw the funds up to the amount of the judgment. Your life savings, the money for your own mortgage, your kids' college fund, it can be gone overnight, without warning. And if that's not enough, they can place a lien on your own assets. Your house, your car, any other property you own. A lien is a legal claim on your property that acts as a kind of public notice that you owe a debt. You won't be able to sell or refinance that property until the lien is satisfied, meaning the lender gets paid first. You become a prisoner in your own financial life, shackled by a debt that wasn't even yours to begin with. The damage doesn't stop there. This entire ordeal, the default, the foreclosure, the judgment, is reported to the credit bureaus. Your pristine credit score, the one that made you an attractive guarantor in the first place, is obliterated. We're talking a drop of over 100 points almost instantly. This catastrophic event will stay on your credit report for 7 long years, making it nearly impossible for you to get a loan for a car, refinance your own home, or even get a new credit card with decent terms. You've been financially blacklisted. And what about the relationship? The son, the daughter, the friend you tried to help? It's almost always shattered beyond repair. The gratitude is replaced by blame, shame, and resentment. Every family gathering is tainted. Every phone call is tense. You didn't just lose money. You lost a piece of your family, a cherished friendship, all because a signature meant to build a future ended up destroying one. So, how do you stop this nightmare from ever happening? If you are considering being a guarantor, you must treat it not as a favor, but as the most serious business transaction of your life. Before you even think about signing, you need to implement a personal protection plan. First, you must have the most uncomfortably honest conversation you can imagine with the borrower. This is not the time for politeness. You need to see their bank statements, their pay stubs, their budget, and their credit report. You need to ask them, what is your plan if you lose your job? What if you have a medical emergency? What is your savings buffer? If they are defensive or unwilling to share this information, that is your first and biggest red flag. You walk away immediately. Second, insist on a formal guarantor agreement drafted by your own lawyer. This is a separate contract between you and the borrower. It does not protect you from the bank, but it gives you legal recourse against the borrower. This agreement should spell out exactly what happens if they miss a payment. It could state that they must notify you within 24 hours of a potential late payment. It could stipulate that they agree to sell certain assets to cover the mortgage before going into default. It could even pre-authorize a repayment plan to you if you are ever forced to make a payment on their behalf. This document turns a vague promise into a set of legally enforceable rules. Third, demand an exit strategy. A guarantee should not be a life sentence. The goal should be to get your name off the loan as quickly as possible. The agreement should set a clear timeline, say 3 to 5 years, by which the borrower must improve their credit and income to a point where they can refinance the mortgage into their own name, releasing you from the obligation. If they can't agree to a concrete plan for your exit, you don't enter. And finally, for the person asking for help, understand what you are asking. You are asking someone to risk their entire financial well-being for you. Before you put that burden on someone you love, you owe it to them and to yourself to exhaust every other possible option. Look into FHA loans, which have more lenient credit and down payment requirements. Explore USDA or VA loans if you qualify. Research state and local down payment assistance programs that can provide thousands of dollars in grants or forgivable loans. Work with a nonprofit credit counselor to repair your own financial standing so you can qualify on your own merits. The greatest gift you can give a potential guarantor is to not need one in the first place. Being a mortgage guarantor can, in the best of circumstances, be an incredible act of generosity that opens the door to homeownership and generational wealth. But it is a financial tool with a razor's edge. It is founded on trust, but trust is not a financial strategy. The path to ruin is paved with good intentions and in signed agreements. When you are asked to guarantee a loan, you are being asked to co-pilot a plane without a parachute. It might be a smooth flight, but if the engine fails, only one of you is guaranteed to crash. The decision is not about whether you love someone enough to say yes. It's about whether you have the discipline, foresight, and courage to build the safeguards that will protect you both if everything falls apart. Because when you guarantee a mortgage, you are not just signing on a dotted line. You are betting your financial life. Make absolutely sure you know the odds before you place that bet.